Hello, everybody. Looks like we've got quite a few people jumping in. Welcome to our Work of Design Live webinar. Hello, Caroline.
Hello.
We'll just let people kind of jump in here. Looks like everybody is rolling in. Awesome. So where is everyone joining us from? Jump in the chat and tell us where you are and how snowy it is. Maybe we were just talking about snow days. Um, Hopefully no snow in Atlanta. I think that's a unique situation. Oh, Minnesota. That's kind of my neighbor. I'm up in Ontario. Yeah, Katie, we have lots of snow here too. North of Toronto. Hey, fellow Canadian. Oh, rain in Seattle. Oh, in Alberta. Sun Valley. Where is that? To brush up on my geography. Give everyone another couple minutes. Looks like there's still people jumping in. Are you all ready for Christmas, Caroline?
Oh, no, I'm not. I feel like Thanksgiving was too late this year. I don't know. That's
Oh,
just
yeah.
my excuse. That's what I'm rolling with. I know yours is in October, but here it's
Hmm.
it's it's
November.
very late. So pushed everything back. Next week I'm planning to catch up though.
That's fun. Do you find that though, like Thanksgiving in November sort of just like kicks off the whole holiday season and everyone's just in
Yes,
holiday mode? Yeah.
yes.
Mhm.
I mean, it's pretty much right after Halloween, actually.
Yeah. Yes, that's true. Yeah. Yeah. Especially with shops.
I know they're all like, all right, Halloween's over, and then they
Yeah.
flip to their holiday
Yeah.
decorations.
Yeah. Absolutely. Absolutely. All right. Well, it looks like people have slowed down jumping in. I'm sure we'll still get a few more, but I'm going to get us started here. Hello and welcome, everybody. Thank you for joining us for today's Work of Design Live webinar presented by Studio Designer. If you're new to us, Studio Designer is the leading business management platform for interior designers, bringing your projects, financials, procurement workflows, and client communication together in one integrated system. Our goal is simple to support the business behind your design work so that you can spend more time creating exceptional spaces. I'm Helena Stevens, part of the Studio Designer team, and today we're excited to bring you a timely and highly practical session set up 2026 for success, the systems and practices to put in place now. As the year wraps up, this is the moment to step back, assess your numbers, and put the right structures in place for clarity and control heading into 2026. And there's no better guide for that conversation than today's speaker. We're thrilled to welcome Caroline, founder of CVW Accounting. Caroline is a trusted financial partner to interior designers across the country, known for delivering high value advisory, meticulous accounting, and a systems forward approach that empowers designers to run stronger, more profitable businesses. She and her team specialize in helping creative entrepreneurs understand their financial forecasts with intention and build operational structures that support long term growth. In today's session, Caroline will walk you through the essential steps to finish the year with confidence and set up the new year for success. As always, we'll have a Q&A at the end, so feel free to drop your questions into the Q&A box at any time. The Q&A box is at the bottom bar along with your chat button. And don't worry, today's session is being recorded and will be shared with all registrants. Caroline, we are so glad to have you with us. I'll pass it over to you and we can get started.
Okay, thank you. Let me share my screen here. All right, can you see that okay?
You are all set.
All right. Well, thank you so much for that um, introduction. I was not expecting to hear all of that, so very nice of you. As Helena mentioned, my name is Carolyn Van Wassenhove. I'm a registered CPA here in the state of Illinois and the founder of CBW Accounting. Um, Here, our focus at CBW Accounting, our focus is on high value services for talented interior designers like yourselves across the country. Before we get started, I think it's important to note that we work almost exclusively with Studio Designer as it's our software of choice. So while today's webinar focuses on Studio Designer and its reporting, just please keep in mind that the principles we discuss are applicable to any specialized interior design software. So today I'll be talking about planning for 2026 and what you can do to set yourself up for success going into the new year. More specifically, we'll touch on strategic planning and how to analyze your 2025 financials to identify what worked and what didn't, how to build a smart budget and forecast that are aligned with your growth goals. We'll talk about cash flow management and how to optimize cash flow to protect your business through project cycles. And lastly, we'll discuss how to leverage your systems and your team structure so your business supports your creative vision and mission. So, first off, what is strategic planning? Well, from a financial perspective, in a nutshell, it's setting short and long-term goals that align with your company's overall mission, and it's creating a roadmap that aims to achieve those goals. And all too often, we're asked, how or where do we get started with this? So we start with a vision. And what that means is, where do we want the company to go? While it's not the only one, a good indicator of the future is the past. And so, in order to create a roadmap or a plan for the future, we recommend you first conduct a thorough financial analysis of your company's past performance, as this will help you better understand your current financial position and give you the confidence you need in the numbers to move forward. So, how do we do this? We have found from experience that those who set a clear vision are more likely to achieve long-term success because they are more resilient, adaptive, and future-oriented. A vision encourages team innovation and it helps you anticipate rather than simply react to things. These are just some tips on what we think a vision should include. A vision should provide a purpose and a direction. It should clarify where the company is going and help your team. Let me back up. It clarifies where the company is going and helps your team work towards that goal. Otherwise, they may just be working hard, being pulled into various directions without any real purpose. The vision should also motivate and inspire your team. People tend to do their best work when they feel part of something meaningful and purposeful. They bring more energy and creativity and commitment when they believe their work actually has an impact. Your vision should also help guide you with strategic decisions and long-term thinking. As market conditions change, which we're currently experiencing now, a clear vision helps you adapt and purposefully strategize versus simply reacting impulsively. Your vision also helps drive growth. It motivates your team to perform at a higher level and encourages innovation. Growth happens faster when everyone is working towards the same goal or in the same direction. And lastly, and very importantly, a vision builds culture. When your team understands the why or the reason your company exists, they feel more connected to the work and to one another. Your vision becomes the cornerstone or the foundation, if you will, for your team's shared values, attitudes, and expectations. So now that you have your established vision, what's next? Well, the next step would be to take a look and analyze your current financial health. The main report that we use for analyzing a company's financial health is the balance sheet. A balance sheet is a snapshot of your company's financial position as of a specific point in time. Now, I could spend an entire webinar just going through and analyzing a balance sheet, as I know, as exciting as that sounds. But in our experience, this seems to be a high risk area as this report tends to be neglected and often overlooked. So when we're analyzing the balance sheet, we want to look for red flags. And examples of red flags include negative numbers, which really just means negative assets or positive liabilities or negative equity. These often suggest either misclassifications or liquidity issues or signs of financial distress. We also look for things such as lack of or aggressive capitalization, inflated inventory, and unrealistic receivables or payables. So, for example, I ran this report in our test company in studio, and I immediately see red flags. One is this client purchases cash account being negative. The fact that it's negative could potentially suggest liquidity issues or misclassification. Um, as I scroll down, I can see furniture and equipment here for $4,500, but I don't see any offsetting accumulated depreciation, which likely means depreciation expense has not been recognized, which is understating our expenses and overstating our tax liability, which we want to try to avoid. We also have balances in our accounts receivable and payable accounts as so we would want to verify the likelihood of these payments actually taking place and adjust or write them off as necessary if they are not. And the reason why this is so important is because in Studio Designer specifically, we run financials on accrual basis, which I'll talk about a little bit later. So if we have bills that are not likely to be paid to the vendors, or if we have invoices that are not likely to be collected from the clients, we would want to consider writing them off, as they would impact our bottom lines, profitability and tax liability. Another line item I see here is inventory. It has a balance, and so we would want to do at least once a year, we'd want to do an actual inventory count and adjust as necessary, as again, this impacts our bottom line and tax liability. This also seems to be an area that tends to be neglected because I realize taking inventory count is tedious and monotonous and time consuming, but it does impact the bottom line. And so we recommend doing this once a year at a minimum, if not quarterly, if you can. Um, as I drop down the report here, as we move down the report, another red flag that sticks out to me is the negative retained earnings of 19,000, which we would want to further research as that could be a sign of financial trouble. Reasons that could lead to negative retained earnings or negative total owner's equity include things such as accumulated losses, which means a business with consistent losses year over year, which reduces or actually depletes its retained earnings. If these losses are greater than the capital that you initially invested, as well as its assets and profit, it will result in negative equity. Another reason for negative equity or retained earnings could be excessive debt. So if your business is taking out loans or is racking up high credit card bills that are in excess of your profitability and assets, this would limit your ability to pay off your debt, which could result in negative equity, which again means the company owes more than it owns. And this results in the net worth being below zero, which is often a serious financial red flag to not only outside investors, but to banks as well. And it's the higher or the more net loss or the lower your net worth is, the harder it is going to be to climb out of that and get any kind of credit buildup. A third reason that could lead to this would be that the owner is simply withdrawing too much money out of the company, which typically leaves the business short on cash to pay its bills or cover things such as payroll. So if I scroll back up here, we can see that we have a balance here in this vendor deposits account and this client deposits account of 121,000. These are deposits applied to items in process, otherwise known as work in process or WIP. All too often, we see WIP items remain uninvoiced despite the goods being delivered or ownership being transferred. And this tends to misstate the financials and tax reporting as the revenue and its matching cost of sales are not being recognized. So again, this is a high risk area because now we're underestimating or we're understating our profit and therefore tax liability. Besides items not being invoiced at all, another risk is that items are being invoiced too early with no purchase order in place, or PO as we call it. So only the revenue or the sales has been recognized with no offsetting cost of sales. And I can pull up an example here. This is an example of what an item looks like in Studio Designer. Um, so I can see here that this invoice has a unit cost of $1,000 and a selling price of $1,300. It's been invoiced, but there's no related PO to it. So if I go into the GL, which is the general ledger, I can see the impact it has on the general ledger. And right now I can see that 1,300 has been recognized in sales floor covering revenue. However, I don't see the $1,000 in the unit cost related to the cost of sales anywhere to be found. So right now, leaving everything as is, our profit is being reflected as $1,300 when the reality is the profit's only $300. So right now, our profit's being overstated, as is our tax liability. So then again, this is another example of red flags that we're diving into deeper when we're analyzing the balance sheet. Another risk related to work in process items is oftentimes we see designers track their office build out expenses in items that are either not being properly classified or capitalized. So here is an example of what an office build out items might look like. This is very typical way for tracking. It's a great effective way for tracking office build out items. But it's very, the key here is to make sure that the sales codes selected are properly synced to the chart of accounts and that things are being invoiced timely and correctly. So in this example, you could see PO 20061 has a unit cost of 1,000 and it has not been invoiced, while the following PO 20062 has a cost of 50,000 and has been invoiced. And so what does this mean? Well, if I go into the GL, which is the next one here, I can see that the impact on the general ledger of this transaction. So the $50,000 we can see is hitting the office build out account as well as accumulated depreciation as well as the depreciation expense. The $1,000, however, is just sitting in this vendor deposits account because it hasn't been invoiced. So, and if we go back to our initial slide here, we can see that only 50,000 was recognized as a capital asset and was depreciated, and that other $1,000 is sitting up there in vendor deposits in that $1,700 balance. So the point being is that this is a misclassification of assets. It's also a misclassification of depreciation, and currently our expenses are being understated as is our and our tax liability is being overstated. So again, this is an area that we'd want to adjust prior to closing out 2025 so that we can look forward to 2026 with accurate and correct information. So if I scroll down here to the bottom of the balance sheet, there's this nice little item that says net profit or loss, and it's reflecting currently around 159,000 in profit. Let's just assume for the purposes of this example that I'm confident with all the other numbers and the business. Um, so the positive 159,000 gives me confidence in that the business is turning things around despite having that negative 19,000 in retained earnings. So where does this $159,000 in net income come from? So let me skip ahead here. Well, it comes from the income statement, which is the report that we use to analyze the company's profitability. And this is probably the report that is most familiar to people. I think that this is what brings people comfort. They understand this report more so than the balance sheet. So this one tends to be the one that is more focused on. While the balance sheet is a snapshot as of a point in time, the income statement displays profitability over a certain period of time. Again, in this analysis, we're looking for red flags. Examples are profit margins that stand out either too high or too low, or not too high or too low, um, high or low in comparison to other months. Overall net losses, or positive income, or negative expenses, or perhaps even just missed regular operating expenses. So I'll move on to the next one. Sorry, I need to move this over here. Next slide shows an example of an income statement, and here in our test company as well. Here we want to look to identify areas that are either highly profitable or not profitable in comparison to other months. And so we'd want to look at things such as the gross margin, which is down here, as well as things as net profit, which is the very bottom row. Gross margin is the profit that's resulting from your sales less your cost of sales, whereas net profit is your total company profit. That's really sales less your cost of sales less your operating expenses. So in my example, just looking at this, I'm going to go back up to the top here. I can see, sorry, I can see this gross margin of almost $60,000, which kind of stands out to me compared to all of the other months. So if I take a deeper dive into things, I see here that we had 15,000 in income freight in November. And if I look to compare it to make sure that there's an offsetting cost, I'm looking at the expense freight and I only see $675. So this kind of strikes me as a red flag because we have 15,000 on the income side offset by less than 1,000. That's a very high profit margin, and that would be wonderful if that's how we could always operate and bill for freight. But this, from our viewpoint, stands to look into things a little further. So let's say I do a little digging and I see here in studio that I found the culprit, what is causing this $15,000 in sales, and it's related to this specific invoice. I can see here that we had a vendor payment. We paid the vendor over $10,000, but the PO is only $675. So chances are this PO was probably entered incorrectly, and it probably should be matching the payment amount. So in this case, this would be a red flag that we would signal to our clients to say, hey, can you please take a look at this? Because as of right now, the financials are misstating the profit. It's showing a profit on this item of 14,325. But the reality is the profits only should only reflect 4,500. So again, these are little things that we'd want to take a look at. Now, going back to our income statement, I'm going to look for other flags. So if I look, so we focused on gross margin um, consistencies. Here we're going to take a look at net profit, and I can see very quickly and evidently that there's a loss of 15,000 in January. And so if I do a little research, I can quickly identify that we had advertising costs of $20,000 in January that we didn't have in any other month. So this is considered an irregular one-time expense. And so in this scenario, we would want to understand the why for the purpose, and for the purposes of this example, we discovered, let's say that it's because it was for a marketing campaign. They took out ads in a magazine, very expensive ads. So now, not just now we know what the 20,000 is a legit expense. It's really for a marketing campaign, but that in itself doesn't suffice. We would want to take it a step further and understand what new business this campaign actually brought in. Was their revenue directly correlated resulting from this cost? We don't want to simply take out an expensive ad and not know whether or not we got any new business from it because we don't want to make the same mistake next year this is a pretty significant cost to our business. So understanding the why, understanding the benefit of the expense is just as important as just simply identifying the expense. We can also see in August that we had some small losses netting to $800. And this is, if I look up, I can see that the gross margins in August were $11,000, which is quite lower than the average gross margins across the other months. So if I do a little further investigation, I can see here that time billing is the culprit or a culprit, as it's only $9,500 in comparison to all the other months that probably average between $15,000 to $30,000 a month. So again, just identifying this $9,500 in itself doesn't suffice. We'd want to get the understanding as to what the why behind this. So, for example, were we sick in August and we were unable to bill as much time billing? And if that's the case, which it very well could be, is this something that we should start considering? Should we start considering bringing in backup or additional support, either on a part-time basis or full-time basis, to prevent months like this from happening again? We want to bring in someone that's billable, obviously, in either, a design capacity or procurement capacity or something of that nature. So it's these highlights kind of present questions to us and gets us thinking about how do we want to address this moving forward? Or are we okay with just having this 1 month because we made up for it with no problem in September? And then from an operating side, um, I didn't really make these numbers stand out a whole lot. I apologize, but we can see here that automobile expenses and office expenses um, increase in August. So we'd want to take a deeper dive into that to make sure that they're classified properly and that they're correct. I also see just looking at this that in June There's negative depreciation of $100. This in itself is a red flag, as depreciation is typically a positive expense. So again, this would require some further investigation and likely some adjustments and corrections for moving forward. In addition to looking for red flags, we'd also want to identify monthly trends. So in this example, we see that we have monthly rent of $3,000 a month, and we have monthly payroll, insurance, accounting, car expenses that are very consistent from month to month. So on average, our total office expenses average a little less than 12,000 per month. And when I spoke earlier about time billing, we said that time billing averaged between $20,000 to $35,000 a month. So this gives us comfort that our time billing, our average time billing, is covering our monthly operating costs, with the exception of January and August, but we've already researched and determined why that happened. So the key here is to understand that break-even point, which means how much do we have to make in a month to cover our monthly costs? Because if we aren't able to do so, then we would need to start making some serious decisions or adjustments to help turn things profitable. And things to consider would be things like increasing our time billing rates or our markup percentages, or perhaps it's going the other way and decreasing our office expenses, maybe moving into a smaller office space with cheaper rent. These are just examples of questions that we'd want to consider as we're moving into 2026. So now that we have analyzed our 2025 financials and we feel confident in their accuracy, the next step for us would be to build a financial roadmap. Um, a financial roadmap is basically a plan or blueprint, if you will, of your business's finances and goals. And this will ultimately help you make key business financial decisions, such as examples are, can or should we expand our office? Can or should we hire someone? Should we adjust or change our pricing strategy? So having a plan in place will not only help you focus on these questions and make these decisions, but it'll help you determine when to put them in place as well. So the first step is to establish financial goals. And similar to the vision, we often see business owners simply working really hard and just assuming or hoping they're making money. This strategy, or lack of strategy for better terms, may work temporarily, but we found that those with clear financial goals in mind, as well as a true understanding of their financial health, are more likely to have long-term success. This goes back to anticipating and planning versus simply reacting. So, um, I'm sure this is very familiar to most of you, but we want our goals to be smart. We want them to be specific and measurable, achievable, relevant, and time-bound so that we can actually put them into action. So, for example, let's say you're a startup and your goal is to replace your old corporate salary within your first year. It helps for you to put that in your roadmap or blueprint so that you can see what it will take for you to get there. So it's not just enough to have this goal in your mind. We need to actually put these goals into written form and into action. And one way that we find to be effective is through budgeting. So a budget is static and it's a quantitative plan for anticipated income and expenses over a specific time frame. You're basically laying out what you expect to happen. We at CVW, we recommend having a 12-month budget in place at the very minimum. But for some, it may be beneficial to look even further ahead with 3 or 5 year budgets in place. The budget provides clarity because it identifies months of profitability or losses, if any, which allows you to make decisions ahead of time and be proactive. I'm not sure if I'm not sure if I'm clear on this, but there's a theme and it's future thinking. So, how do we build a budget? We typically start with last year's financial reports, which is one reason why we want to analyze them and make sure that we're comfortable with the numbers. And then we adjust them for any known contributors or assumptions from there, such as any projects that we already have in the pipeline or changes in operations that we can expect, such as um, say our rent is expected to increase in the middle of the year, or we expect to give salary increases or bonuses, or we know that our insurance premiums are going up. These are all assumptions that we can uh, predict with confidence and we should incorporate into our budget. So here's an example of what our 2026 budget would look like. We would start with our 2025 income statement and then we'd adjust for any known changes, just as those that I mentioned. So in this example specifically, I'm saying that we know that our projects that we have in our pipeline are through the end of June, as well as the anticipating timing of our invoicing is at the end of June. So we will factor that revenue and the related costs of sales into our budget. And so we also know, I spoke about potentially knowing about a lease increase for our office space. If we know that's going up to 3,500 from 3,000 in June, we would want to incorporate that as well. Um, and if, let's say in this case, we don't have any projects in the pipeline that are extending beyond June. Um, so if we don't have these, we can see that just from our break-even analysis from our actuals from last year, we need to be able to cover on average 12,000 a year to pay our office expenses. Because it's now 2026, that number probably needs to go up a little bit for anticipated cost of living increases and so forth. So we would want to anticipate or set a target goal of at least 15,000 in time billing per month. And that's just to cover our monthly expenses and break even. So this now becomes our target goal. And if we know as we're approaching July that we are not going to be able to meet that goal, then this is when we would have to make some serious decisions prior to July. Um, so we wouldn't want to wait for July or wait till October until cash is just depleted and we're in a serious state of trouble. We'd want to make these decisions ahead of time to better prepare for them. So we would go through this process going line by line item for each of these accounts and incorporate any known assumptions that we have related to 2026. So once we have our budget established, we'd then input it into our software, which is Studio Designer for us, and so that we could run these comparison reports that compare our actuals versus budget. We'd want to save a copy of the original budget to create that baseline and really to allow us to compare the company performance, what happened to what we expected to happen initially. And that report looks, this is again from our test company, but this is an example of what that report would look like um, in terms of showing us any kind of variances. Oh, we can see here that we actually exceeded our our anticipated sales by $27,000. We looks like we did a lot better than what we were anticipating, which is great. However, we can see here that our gross margin is up almost 100,000, but our total net profit is up. 90,000, which means that our operating expenses didn't go up relative to our sales. Office rent remained the same, salaries remained the same, um, automobile remained the same. So this is just highlighting uh, the good and maybe the not so good as to what we were expecting for the year. Now, as you become aware of new information throughout the year, we don't just recommend you create a budget, you set it and forget it. We recommend you update it with new information that you're learning throughout the year, and this is otherwise referred to as a forecast. While a budget is static, a forecast is continuous. It continuously adjusts for known factors or market trends throughout the year. So let me move forward one more here. Here's an example of what a forecast might look like. So in our example, let's say 3 months has passed and we'd want to update the first 3 months with actuals. Um, and so we do that, and then in mid-January we sign on a new project and plan to start delivering in May, which is great news. So now this is new information that we didn't have last year. So we'd want to incorporate this new project into our forecast with the additional information, which I've highlighted in green. Now, we know bringing on this new project, we likely can't handle it by ourselves, and we're going to need some additional help. So again, this would allow us the opportunity to plan for hiring somebody new, whether that be a design assistant or perhaps a contractor to help with procurement. Whatever the case is, we'd want to input these additional costs as well so that we can truly see the impact on the bottom line. So we don't want to just put the revenue side of it. If we're anticipating um, higher costs because we're having to hire more people, like I've highlighted here in yellow, bringing on, say, cost of labor for procurement, and then let's say we are hiring a design assistant, so our salaries are going to increase. We want our forecast to reflect this new information. And if we do bring on additional help, let's not forget how that may impact time billing, because our target time billing goals would likely need to be adjusted as well to cover our new break-even costs. And they should also reflect any additional revenue that we expect to gain from adding these two new people. So again, these people would likely be billable, and this would help alleviate those months that you are either out sick or wanting to take vacation. So again, this is looking forward, planning ahead, and adjusting things as necessary. So let's go down to the bottom here. I have the original budget lines in column O along with our new forecast totals in column N. As you can see the impact of one new project, you can see the impact just one new project has on the bottom line. Obviously this is an example and not every project's going to have the same effect on the bottom line, but for the purposes of this example, we're illustrating that one new project is actually bringing in an additional, or we anticipate it to bring in an additional $65,000 in profit, despite bringing in additional uh, costs related to salaries and cost of sales. So while we originally predicted 180,000 net income, we are now expecting to make 244,000 in income based on our updated forecast. And this information, it's useful for, making decisions like, do we want to continue growing or hiring somebody else or moving into a larger office space. But it's also very useful for business owners to provide to your tax preparer because they need this information to continuously adjust your estimated tax calculations and tax payments. So we as LLC owners or S Corp owners, um, are required to make tax estimate payments throughout the year on a quarterly basis. And if we are making them too low, then we're going to get hit with a large bill in April that nobody is a fan of, as well as likely some interest and late late payment fees as well. Because if you're paying too low, the government isn't dumb. They want their money. They know that you're making money all year, and they're going to nail us for not paying that money that we made earlier in the year. Um, they're very smart, and they want their money quickly. So this is a way to help keep our tax accountants updated so that we're staying on top of our estimated payments and adjusting them up or down as needed, because the same goes for the opposite. If the company is predicted to take a big hit and we're going to drop a lot in profit, you don't want to continuously put yourself in this difficult position of paying these high tax estimates when we know the company's not going to be making as much money as we originally predicted. Hopefully that's not the case, but it can happen. So just something to be aware of. So the next topic of discussion is usually a favorite. So now that we have our financials analyzed and our budgets and forecasts are set, let's talk cash. So why is cash flow management important? Um, It's especially important for interior designers and this industry because this industry typically involves upfront costs and has intermittent revenue coming in and typically has long project timelines. So the objective of this is to optimize your cash flow and protect your business through these project cycles. Due to the nature of the industry, studio designer uses the accrual basis versus cash basis for its accounting and reporting purposes. And if you recall, I talked a little bit about this in the beginning, but right now I'll get a little bit further into it. What's the difference between accrual and cash? Accrual basis accounting means that revenue is recognized as it's earned. And this is typically when the goods have exchanged ownership, or a job is complete and you've sent your final invoice to the client. Expenses are recognized as they are incurred. This is referred to as the matching principle because it matches the expenses against the revenues that they helped generate. So you're going to see if you sell a table for 10,000 and it cost you 5,000, you're going to see the sale of 10,000 in that month. You're going to also see the $5,000 cost in the same month, resulting in that $5,000 profit all in one month. That's the beauty of accrual basis. Cash basis, however, recognizes the revenue as the money is received and the expenses as the money is spent, making it a little bit more difficult to understand a project's true profitability as of a certain point in time. Um, so, for example, if you collected $10,000 on a table in February, but then you didn't pay the vendor the $5,000 until March, February is going to look like you had this great month of $10,000 in profit, and March is going to look like you had a difficult month with $5,000 in losses. And really, that's not the case. You did make 5,000 on that table, but it's a lot more difficult to pinpoint to where how that $5,000 in profit was derived from. So, since studio uses the accrual basis, which is our preference, revenue and cost of sales are recognized when an item is invoiced. So regardless of when the payments are received or paid, the gross margin is recognized once that invoice has been created. So it doesn't matter if the client paid you. If you created the invoice in February and the client paid you in March, the revenue is still going to be recognized in February, as well the offsetting costs. Um, so the accrual basis actually provides a more accurate picture of the company's financial performance, in my opinion, and a clearer picture of how the company is expected to perform in the future. It's favorable from both a profitability measurement and a long-term planning standpoint, because the industry is so capital intensive, meaning it requires a lot of cash to come in and go out the door. That's never really the designer's cash. It's really important to measure the company's cash flow position, um, outside of simply measuring its profitability. And so, how do we do that when we're working on an accrual basis accounting system? Oops, went a little too far. So there are three methods that allow us to really address that infamous question, how much cash is mine? The cash flow snapshot, cash flow projection, and profit, a version of the profit first system. The cash flow snapshot is a method that summarizes the cash inflows and outflows of the business. It provides the liquidity and financial health of the company at a glance or as a specific point in time. Basically, it's a snapshot of where you are based on past activity or where you would stand if you were to say close all the doors tomorrow and you have to collect from all of your clients, pay all your vendors, pay out all your loans. What would that pay off all of your loans? What would that look like? So here's an example of a cash flow snapshot that our team regularly prepares for our clients. Um, Here in this example, you can see, these numbers are all being derived from the data that's available to us in studio. So again, this goes back to making sure that the data is accurate, because most of this information, if not, yeah, most of this information is pulling from the balance sheet, which was that report that I said tends to get neglected. So here we can see, we have the accounts receivable that's coming from the balance sheet, accounts payable, our monthly operating expenses were 15,000 a month. We have some credit card bills, some sales tax, all of these things. So this is how much cash we have left available. And if we wanted to project what it looks like in the future, because we have a lot of projects in process, we have a lot of money already applied to projects, but they're not complete, the ownership hasn't transferred, then we could do a little snapshot of what that future would look like, again, based on the data available to us. The only real assumption we make here is that we're using 3 months reserve for our operating expenses, which is what we recommend business owners save or have in their savings available to them for in times of crisis. So a second method is the cash flow projection, um, or otherwise known as a cash flow statement. So while the cash flow snapshot provides a clear picture of the company's current financial health, the cash flow projection is forward-looking. It's a more forward-looking tool that helps predict future cash needs. So the projection breaks down the timing of the cash inflows and outflows for a specific period of time, whether that be weekly, monthly, or quarterly. And this helps you manage liquidity by identifying those periods of cash shortages. And it helps determine if the company has sufficient cash to operate or pay its owners or expand. So to create this report, we recommend starting with the budget and then adjusting it for cash basis. So in our example, um, we had $10,000 invoiced in January for sales furniture, but we know we will not be collecting it until February. So for cash purposes, we would move this 10,000 over into our February sale in addition to the 5,000 that we are anticipating collecting. So that's highlighted in orange. And with regards to the $50,000 rug that we invoiced in March, which I'll just jump back to real quick. So as we can see here in cell D11, we have $50,000 in sales floor covering in March. because that's when we were anticipating to invoice it. If I go back up to my cash flow projection, I have them highlighted in orange because we our policy is to collect 50% up front and then another 50% midway through the project. This is an example, not necessarily the way I recommend doing it, but for the purposes of this cash flow, I just kind of wanted to illustrate the timing of cash. So in the budget, we're showing 50,000 in profit in March, but from a cash perspective, we're actually showing the 25 coming in January and February. So this is the difference that between the two. And we would want to adjust, go through line item by line item and projects and adjust for actual cash versus profit. The two are very different. They're related, but the timing of them can be very, very different. Um, and Speaking of timing, time billing is a great example. So I think it's very common for designers to do all their time billing that's dated the last month or the last day of the month, but they are not actually collecting it until the following month. So again, if I were to go back to that initial budget, all of this time billing that I see would all be in the month prior to the month that I'm reflecting here on this cash flow for collection purposes. And if we remember our infamous $20,000 um, advertising, let's say we got the bill in January, so we're going to recognize the expense in January, but we're not actually going to pay it until February. We would want that reflected in the cash flow as well. So utilizing this cash flow, we can see how it impacts the bottom line, and it highlights any months that we might have cash uh, shortages, or and so which allows us to prepare for those cash shortages. So we don't want to spend every dollar that's coming in because we know that we're going to have months that we're going to have cash shortages that I've highlighted here in red. Um, and it also, for example, so I mentioned the deposits being collected up front, and we're seeing more and more designers move away from this 50-50 method, and you're collecting deposit 100% upfront. So, which is great. We don't want our clients to be their client's bank. We want them to have the money to then be able to go and purchase the furnishings and etc. But that if you're not properly tracking that and understanding when you're going to need that cash, because you might be getting all of it, say that floor covering, if you're getting all of it in January, February, but you might not owe it all, or you might owe all of it in February. You don't want to go and just spend it all without realizing, oh wait, I have to pay 35,000 of this in February. So this is capturing what you know, what you need to pay, when you need to pay it. And then again, just like the budget, we want to adjust this for any known changes that come up. This should be, we recommend this be a rolling cash flow, which means rolling 12-month cash flow, excuse me, meaning this is getting updated every single month and it extends beyond December. So if we're in February, it would look February through January. If we're in May, it would look May through April. So we want this to be a rolling, future looking report so that we're always on top of where our cash position lays. And it's not a surprise when we actually have to um, pay a vendor. A third method that some of you may be familiar with is our version or a simplified version of the profit first system. This system was created by Mike Michalowicz, if I hopefully I pronounced it correctly. And his website is noted at the bottom here. But I read his book a few years ago, and while he talks about utilizing several bank accounts. I thought it was so applicable to the interior design industry that we now use it as our third method to that we offer to our clients to help manage cash flow. So with this method, sorry, I lost my train of thought. So with this method, we utilize various bank accounts for different business needs. And again, this goes back to that infamous question, how much money is mine or how much cash is mine? So for those that have difficulty reading reports or don't like reports, or you can't afford to wait on your bookkeeper accountant to provide you with a report, then this could be a great solution because it allows you to manage your own cash just through bank accounts in real time. So let's look at what this would look like. So this is an example of um, how we would approach a client deposit on a proposal. So if we're collecting 100% upfront, which again we recommend you do, we would in this case, let's say the client paid us all $14,170 for this proposal. Now, as we move down to row 17, we can see it all hits our operating cash. Well, we know 10,000 of this is needed for the actual product itself. So the moment that cash hits our bank account, we're going to transfer 10,000 to a separate bank account for product cash only. We're also going to go an additional step and transfer that $1,100.70 of sales tax into a separate uh, account that we would name sales tax account. And so that would only leave us left with 3,000 left in the operating account. That's the money that we would use to pay our bills, pay rent and salaries and so forth. Obviously, 3,000 isn't sufficient to cover our monthly expenses, but if you're collecting 10 proposals a month, this is how we would build that operating account. And so um, we've even suggested taking things a step further. You know, if you're wanting to put money away for taxes, which we highly recommend, because again, getting hit with those estimated tax bills or tax bills in April when you're not ready for them, that could be really gut wrenching. So depending on your tax bracket and percentage, um, we recommend transferring a certain percentage, whether that be 25%, 30%, 20%. That'd be something to discuss with the tax accountant, but we'd want to transfer a percentage of that 3,000 into a separate account to pay our taxes. So now you can quickly see how what looks like 14,000 in cash really is now leaving us with $2,250 in cash to pay our operating expenses. So, um, so what's great about this method is that it allows the designer to log into their bank accounts and then they could quickly see, okay, I have 2,200 in my operating account. I have 750 in my savings account for taxes. I have 1,100 in sales tax and I have 10,000 for products. And so we would want to make sure that you'd have a separate credit card specific for product purchases only, and you would pay that credit card through that product cash account. And then you'd have a separate credit card for your operating expenses, such as meals and taxis and hotels, and you would pay that credit card out of your operating cash. So the key here is there are a couple keys here. One, the designer or the person managing this process needs to be very diligent about the transfers. The entire system breaks down as soon as a transfer is missed. The moment a transfer is missed, now there's going to be shortages in certain accounts, and that's going to lead to frustration. That's going to lead to wondering what the heck happened. How did I run out of money? So the transfers need to be consistent and immediate upon every single deposit or invoice balance that's coming in. Um, Not only does it need to be um, diligent, but it needs to be accurate. So if you're paying for your product credit card out of your operating funds, then that's going to obviously cause a cash uh, deficit in your operating account versus your product account. So this method, while it's very simple, it avoids the use of waiting on your accountants and bookkeepers to provide you with reports. You can just log in and see very quickly. It gives you that idea of how much cash is truly mine. But the key is to make sure that the transfers are done consistently and timely, and that the amount collected covers the amount that is due to the vendor. So if you're only collecting 50% deposits up front, but you're paying the vendors 100%, you're going to see quickly as well that this methodology is not going to work because of the system that's put in place. And you'd want to probably reconsider um, collecting 100% deposit versus just 50%. So our last area to touch on is operational efficiency and how to leverage your systems and your team structure. Um, so how can we leverage our systems to be more efficient? Well, we can't fix what we don't know. So the first thing we'd want to do is standardize our processes and map out our workflow. We do so by documenting the steps or tasks involved from the initial client discovery call to the final install. The map helps us visually identify areas of inefficiency and repetition or waste that we need to address. So, by documenting the processes, we are setting the expectations, which allows us to hold ourselves and our team accountable. The documentation also helps streamline things like employee training and onboarding, as well as client onboarding. Secondly, and this is a hot topic, I know that's on everyone's mind for 2026, is we want to utilize technology and AI to streamline our workflows. AI is a great tool for increasing productivity as it can help automate repetitive tasks, things like templates and workflows and documentation. The key is to identify time-consuming tasks like scheduling and writing and integrate AI tools for automation. So you can start with something really simple like ChatGPT or Gemini for general tasks, and then add more specialized tools as they become more available and as they become better, that can help with things like personalizing designs for your clients based on their needs and preferences, or things like creating visualizations such as mood boards very, very quickly. Now, I want to stress that it's important to note that this is not a replacement for human creativity. It can just help bring ideas to life more quickly and efficiently, and may even present options that otherwise wouldn't have been considered. So, again, change is coming, embrace it, and I think it's going to continue. There's always going to be new options available. Try some. Don't be afraid to try new ones. The ones that work great. If they're not working to your liking, then move away from them quickly as well. You don't want to stay working with something that is inefficient. We also want to utilize industry-specific technology, and as you heard, I've talked about Studio Designer specifically throughout this webinar. Um, the reason we prefer working with a specialized technology is because it helps integrate project management, accounting, and sourcing all in one. The software allows us to better track time, manage budgets, track financial data, and it allows our clients to communicate directly with their clients as well through things such as client portals. And that just enhances their overall experience as well as our clients' overall experience. So, how do we leverage our team structure to be more efficient? Well, the first thing we want to do is clearly, I mentioned this above, but clearly define and assign roles and responsibilities to avoid confusion or duplicate efforts and really hold our team accountable to their responsibilities. We want to utilize each member's specializations and their strengths to foster this culture of collaboration so the team feels comfortable sharing ideas and offering constructive feedback. We also want to systemize communication and define our communication channels. How should updates and questions be handled? And we want to ensure those questions are being addressed timely. So we don't want to ask for feedback and then just leave it to the fall and not actually follow up on it. And lastly, and very importantly, we want to empower and invest in our team as they become more productive and more eager to perform strong as they are empowered. We want to encourage ownership and provide them with growth opportunities to avoid things like costly turnover and productivity disruptions. So, really buying into your team, really empowering them to best utilize their strengths and just build an environment that allows them to be at their best. So to wrap things up, our key takeaways from today is if you don't already have one, set your company vision or mission statement. Analyze, and this could be with the help of your current bookkeeper or accountant, but analyze your current company financial position. Really get a handle and an understanding as to how your financial position lays. Create and align goals with that vision. Put your goals into action, whether that's through budgeting and forecasting, whatever it is. It's not enough to just, oh, I want to make this much money a year. Really put it in writing and lay out how you plan to get there. Know your cash position through various cash flow methods. We offered or I talked about three different methods. Each method has its advantages. Each method is beneficial. They don't know, all need to be used. I recommend at least using one method in some capacity just to have an understanding of your cash position. And lastly, leverage your team and your systems. Really build your team, rely on them to help you out and just to allow you to be more productive and more efficient because in the end, that's going to be reflected on the output and it's ultimately going to increase your customer satisfaction. And that wraps it up for me. So if we want to take it into questions,
Yes, hello. Hi.
hello.
That was awesome. That was a lot of information.
I
We dove
know, I'm
deep in there.
sorry.
Yeah, no,
An hour. I'm
we've
sorry.
still we've still got people in there ready to hear us. So that's really
Okay.
great. Yes. So I will start with a question from the chat, which I think is going to be pretty simple. It was actually on one of your spreadsheets. Someone just asked what suspense was on that column.
Oh,
Yeah.
yes. So that is in QuickBooks, I think it's called Ask My Accountant or uncategorized expenses. It's really just a placeholder for transactions that our team isn't sure about, and we want to follow up with our clients to determine is this related to a PO or is this an office expense so that we make sure that we're properly classifying it. That account should be zero. At the end of the year, we don't want there to be a balance in that account. And really, that account should be zero month after month after month. We don't want things lingering in there from month to month. We want those addressed timely so that the financials are properly stated. Otherwise, as you can see, it's going to misstate them.
Awesome. All right. And before I jump into the next question, I am going to just I'm going to launch a quick poll, sorry, just to see who is here in our audience still that might want some more information about studio designer or CVW accounting. And I'm going to launch that now. We jump into the next question. So thank you very much for that feedback. So there is actually two questions, or maybe three a little bit around like if you have any templates of the spreadsheet that you shared with the different categories. There was another one that asked if you have a top 10 red flags tip sheets. It says the top 10 that you see regularly that will help me as a solo business owner fine tune my finances for my accountant. So I guess like what do you see as those top 10 kind of red flags, and if you have any templates available.
So the account classifications are coming from Studio Designer. So just like QuickBooks might come with a standard chart of accounts, Studio Designer comes with a standard. And what I love about Studio Designer is it's very much driven by job costing. So it allows you to see quite easily if you're making money on windows versus rugs versus accessories. So those breakdowns, they can be customized. We customize them for our clients as needed, but that's just the standard that gets spit out in Excel from Studio. I exported the reports just so I could manipulate some numbers and highlight some things and stuff like that.
So they are pretty standard headings that would be
Yes.
in other accounting softwares. And so I'm not sure, Colleen, I'm not sure if you're still here actually, but if there is something more that you wanted to know about that, please jump in the chat. The next question was a WIP item that has been invoiced too early but didn't have a PO number. How do you generate that correctly?
So we would, right, that's a good question. So we would need to do some back end fixing on that. We would create the PO. And the issue with that is the PO is going to be dated for whatever date. So if we created it today, the PO is going to be dated today. And we would need to go on the back end and adjust the date to match the invoice date. We wouldn't want to void the invoice because then we're going to be impacting sales tax. So the idea is to match the cost with the sale versus moving the sale to match the cost, if that makes sense. So we would add the PO and then backdate it to in the GL side of things.
Great, great. And this was, I think, based on the cash flow questions. How is separating tax payments into a separate bank account different than paying a quarter tax estimates?
It's so the purpose of saving, so you're only paying these tax estimates like every quarter, but you're collecting money, every day, every week, every month. And so I trying to prevent people from spending that money that needs to be saved for those estimated payments. So if you put away that 25% or 20% or 15%, whatever it is, into a separate savings account, that's the account you would use to write those checks to the US Treasury. So it's really just a savings account specific for those tax estimates.
Awesome. All right, I've got two more. One of them is how often, sorry, should we review our income statement during the year? Is this something we should do monthly or just at the end of the year?
Oh,
And that,
definitely monthly. We want to
um,
review our financials every month. Because if we wait till the end of the year, it could be too late. It likely is too late. And it's much harder to go back and try to fix things or get information needed. If you don't know what this cost was for, it's going to be a lot harder to go back to the vendor and figure that out. Part of our processes internally is that we issue monthly reports by the 15th of the month. We review them with our clients and then we address any of those questions at that time. So that at the end of the year, like right now, it's not that big of a deal in comparison. We're doing the same thing over and over and over. It's really just rinse and repeat. We want this to work like a well-oiled machine. We don't want it all to just be pushed aside and then it's a fire drill at the end of December or January.
All right. And then I think you did touch on this a little bit, but can you use forecasting to decide if you should do another project or if you have capacity to do another project or bring on an employee?
Sorry, what was the question? I missed the question.
Sorry, can you use forecasting, like the
Oh,
forecasting? I think when you were doing that,
mhm,
like, adding staff people and salaries and everything
mhm.
in there, can you use the forecasting to decide if you should do another project or if you have the
Yeah,
capacity to take it
absolutely. You
on?
can
Mhm.
see, yeah, absolutely. You can see what your capacity lies, and you know with your scheduling, and if your team is already at max capacity, and your profitability is nice and you have nice margins, nice profitability, you can see, okay, well, we'll take on this project, but we might not want to start it for 6 months. And if the client, is very diligent, wants it to start immediately, then that would give you the opportunity. Well, maybe we need to hire somebody a lot sooner or whatever the case is. But yes, I mean, the forecast is, I mean, I personally use it for my own decisions as a business owner as well as like when we're ready to grow. You want to plan for it. If you already have all the work and you don't have anybody and you need to bring them in for training and all of this, then you're already going to be behind and the quality of work might not be up to your standards at that point. So it's really about looking ahead, planning ahead. And to be honest, I mean, all of our clients are very, very understanding. They're wonderful people. And so if there's something that we need to push off a month, as long as we have that conversation, then they're always very understanding about it. But it's just knowing, okay, we can do this, but it's not going to be for another month or two.
That's awesome. And I think that's all the questions that have popped in. And you have a shout out in the chat right now, so that's nice. So thank you to everyone who held out 20 minutes. Yeah, we we dove right in there. That's great. So thank you, Caroline, for such a focused and I'd say actionable session. Like I even have some takeaways, and I don't even run a business. I'm like, "No, I could do this with my home budget."
I know it's hard to get
But
it all in
yeah.
1 hour, so I could talk about each
Oh,
section for like hours, but yeah.
we'll do our own series.
Yeah,
Yeah.
exactly.
Well, we appreciate you taking the time out of your day to share your expertise. So
Well,
thank you again very much.
thank you for having me. I appreciate it.
Absolutely. Yeah. And thank you to everyone who joined us today. As we said, we covered a tremendous amount of insight on what it takes to close the year strong and prepare for the new one. This foundation is exactly what sets designers up for a profitable and stable year ahead. Here at Studio Designer, we are committed to supporting that foundation from job costing and time tracking to budgeting, reporting, and procurement management. Our platform gives you the clarity you need to understand your numbers and the structure you need to run your business with confidence. We hope today's session gives you the direction and momentum to enter 2026 with the focus and control that you need. And on behalf of the entire Studio Designer team and Caroline and her team, thank you again for spending this time with us. And we look forward to seeing you at the next Work of Design Live event.
Thank you.